If you're a US expat, you already know federal taxes are a maze. But honestly, that's nothing compared to the minefield of state tax residency. So many people think that just by moving overseas, they've cut the cord with their old state. But as we're about to see, that assumption, well, it can be an incredibly expensive mistake. Okay, first things first, we have to nail down the most important word in this whole conversation: domicile. Now, this is not the same as residency. Residency can be as simple as where you're physically living right now. Domicile, on the other hand, is a much deeper legal concept. It's all about your intent. Think of it as your permanent home in your heart and mind, the one place you'd return to if you left everywhere else. And that subtle difference, that's the hook states use to keep you on their tax rolls, long after you've gone. And right there, that's the core of the problem. Believing that your new address in, say, Dubai or Lisbon automatically severs your ties to California or New York is probably one of the most dangerous, financially lethal misconceptions out there for American expats. States are getting smarter, they're getting more aggressive, and you better believe they're using data to track you down. And the real kicker? The burden of proof to show you've left for good? Well, that's 100% on you. So, here's our game plan for today. We're going to start by digging into why this concept of domicile is so hard to shake. Then, we'll look at the federal tax rule, that's IRC Section 911, that gives so many people a false sense of security. From there, we expose the big one, the state nonconformity trap. We'll even look at a wild tax court case that shows how brutal the rules are. And then, we'll wrap up with the exact step-by-step playbook you need to protect yourself. All right, let's talk about the persistence of domicile. You see, your federal taxes are based on citizenship. As a U.S. citizen, you're taxed on worldwide income. Doesn't matter if you live in Ohio or on the moon. But state tax is a completely different animal. It's all about domicile. Once a state locks you in as a domiciliary, that status is, for lack of a better word, sticky. It just hangs on to you, pretty much forever, until you can prove beyond a shadow of a doubt that you've cut ties and established a new permanent home. So that brings us to this idea of sticky states. These are the states, and you can see the usual suspects here: California, New York, Virginia, South Carolina, New Mexico, that are notorious for aggressively hunting down former residents. They're not just hoping you'll file. They have auditors, they have data sharing agreements with the IRS, and they will absolutely come after you for taxes years after you've moved, basically daring you to prove that you really truly meant to leave forever. Now, let's talk about something that throws a lot of people for a loop and creates this incredibly dangerous false sense of security: the federal tax code, specifically the Foreign Earned Income Exclusion. A lot of expats know about this, they use it, and it can wipe out their federal tax bill. And that makes them think they're totally in the clear. But they're not. Let's see how it works. Okay, so here's the technical bit. Internal Revenue Code, or IRC, Section 911. It's a huge deal for expats because it helps prevent double taxation, right? If you're a qualified individual, you can choose to exclude a big chunk of your income that you earned abroad from your U.S. federal taxes. But pay close attention to those words: foreign earned income. This has absolutely no effect on passive income. We're talking dividends, interest, capital gains. That stuff is still on the table. And to put a number on it, this exclusion amount goes up with inflation every year. So for the 2024 tax year, we're talking about a maximum of $126,500 per person. And it doesn't stop there. For 2025, it jumps up to a nice round $130,000. And by 2026, it's projected to hit $132,900. Now think about that. For a married couple working abroad, you're talking about shielding more than $250,000 from the IRS. That is a massive federal benefit. But of course, you don't just get it, you have to qualify under one of two really strict tests. The bona fide residence test is more subjective. It's about proving you set up a real life in another country. But the physical presence test? Oh, that one is just cold, hard math. You have to be physically outside the U.S. for 330 full midnight to midnight days in any 12-month stretch. And they are merciless about this. You miss it by one day. Maybe a flight gets canceled or you have a family emergency, and boom, you fail the test. No exclusion. Okay, so here's where it all comes to a head. This is the moment the trap springs shut. You've passed the test. You've filed your federal return with Form 2555. Maybe you owe the IRS $0. You're feeling great. You're safe, right? Absolutely not. Because this is where the states step in, and your beautiful federal tax break can just vanish into thin air. And this chart just lays out the danger perfectly. You have to remember, states can pick and choose which parts of the federal code they want to follow. It's called decoupling. And look at California, Massachusetts, Virginia. They have what's called strict non-conformity. They look at your federal return and say, that 126 grand you excluded, that's nice, now add it all back. And what's worse, they then say, oh, and those taxes you paid to Germany or the UK, we're not giving you a credit for that either. It is brutal. Let me just state this as clearly as I can. If a sticky state still believes you are a domiciliary, you get slammed with a catastrophic double taxation track. The salary you earned in London gets taxed by the UK government, and then that exact same income, the money the IRS agreed not to touch, gets taxed all over again by your old state. It's an absolute nightmare. Now, if the sheer financial risk of that isn't enough to get your attention, let's talk about just how unforgiving the rules can be. The tax code isn't about close enough. It demands perfection. And there's no better cautionary tale than a U.S. tax court case called Wessenfelder versus Commissioner. It's a real wake-up call. I want you to look at this very specific, very legalistic phrase on the screen. This isn't a suggestion. According to Treasury regulations, this exact sentence is a command. If you're making a certain kind of late election for the Foreign Earned Income Exclusion, this statement has to be typed or written legibly, right at the top of the first page of your Form 1040. Not in a letter, not on another form, on the 1040 itself. So what happened with the Wessenfelders? They simply failed to put this exact statement on their return. They argued it was a tiny mistake, an oversight, that it didn't change the numbers. The tax court completely disagreed. They ruled the omission was a fatal error. The entire election was thrown out as invalid, and all of their foreign income became fully taxable by the IRS. It just goes to show you, when it comes to taxes, procedure is everything. Okay, we've laid out the problem, we've seen the risks, we've looked at the procedural nightmare. So let's pivot to this solution. How do you actually, truly, and legally sever your domicile? It's not one single thing. It's a deliberate, methodical process designed to build an ironclad defense for that audit that might come years down the road. These are the big moves, and every single one is about proving your intent to leave for good. You have to sell your main home, because keeping it, even if you're just renting it out, screams, I'm coming back. You have to cut your civic ties. That means surrendering your driver's license and canceling your voter registration. These are powerful legal declarations of residency. Move your financial life. An old dormant checking account is a breadcrumb an auditor will follow. And where your spouse and kids are located, that's a huge one. Finally, you have to formally tell the IRS you moved with a Form 8822. Each action is another brick in your wall of defense. And you absolutely must document everything. Remember, the burden of proof is on you, not the state. You need to build your own audit file from day one. Keep copies of your foreign lease, your visa, your utility bills, the receipt you got for surrendering your driver's license, everything. Because when that audit notice shows up 3, 4, or 5 years after you moved, this file, this is your only defense. It's your shield. So this all boils down to one final, critical question you have to ask yourself. When you moved abroad, did you draw a clean, clear, undeniable line in the sand? Or are there lingering ties? That old bank account you kept just in case, the driver's license you never got around to surrendering, that are basically an open invitation for a state auditor to come knocking. Because in the world of domicile audits, any ambiguity you leave behind is a liability you simply can't afford.